Hello, and welcome to Inside the Markets Summer 2023. I'm Peter Robbins, and I'm the Investment and Technical Manager here at Henwood Courts, and I'll be taking you through a brief overview of markets this year to date. The second quarter of 2023 was a strong one for investments. This might come as a surprise to many of you, given that it was a quarter that many central banks were taking the opportunity to raise interest rates. However, as we can see here, if we look at global markets as a whole, we can see that there's a positive quarter returning 3.2%, building on strong returns seen in quarter one. A large reason for this was there was a group of mega cap stocks that delivered exceptional returns, with this being a positive trend that continued from the first quarter, as we saw enthusiasm continuing throughout the world for AI. Therefore, it's probably not surprising for you to see that the US emerged as the top performing market with a return of 5.8% due to the US's large exposure to tech companies. Also, we saw in the US that inflation fell to half of its last year's peak. Whilst the Fed raised interest rates in May, it didn't increase them in June. Finally, in the US, we saw there's a lot of news about the debt ceiling, and that we saw after a lot of back and forth, a deal was agreed to increase the limit there. If we come closer to home, we can see that the UK recorded a marginal fall of about 0.5%. This was largely down to the UK's large exposure to oil markets and other cash generative stock companies, which face challenges in comparison to other developed countries. The absence of large mega cap stocks in the UK also resulted in some of the lag. Finally, we've still got this turbulence around the political landscape and this inflation that we keep seeing that's remaining stubbornly high. That's deterring investors. If we hop over into Europe, we can see there was a small gain of 0.6%, largely resulting from financial and IT sectors over there. We saw that the Dutch government confirmed that high-end chip manufacturing machines will require a license to be shipped, which could reduce exports to China. The Netherlands is home to some leading chip equipment makers. Therefore, some driving returns there also relating back to this boom in AI that we're seeing. If we move into the emerging markets, we can see there was a fall of about 1.7%. Tensions continue to be high between the US and China. Obviously, we know that China is a major driving force behind the emerging market sector. Here we saw that the economic rebound in China following the country's reopening from its COVID crisis started to cool, factory output started to slow down, and there was a lackluster consumer spending, which weakened demand for exports. So, China struggling there. But in the emerging markets, it wasn't all bad news. Hungary, Poland, and Greece were some of the top performing markets, despite the rising recessionary fears in Europe. Central banks in Hungary actually cut rates in June, and Greece's outperformance came as the new ruling Democracy Party won a second term in office in May, which signalled a continuation of market-friendly policies there. If we move on to the global factors and tilts that we adopt in our portfolios, we can see that global value delivered a positive return of 2.3%. Global smaller companies, marginal return of 0.6%. Global property down 2.2%. Looking at value, it's particularly rewarded disciplined investors with its largest one-year outperformance of growth since 2000. Whilst global property is down 2.2%, due to it not being correlated to global equities, it still has an important role to play in our portfolios. Finally, looking at defensive assets, the second quarter of 2023 saw a significant drop in global bond market volatility. Government bond yields were on the rise, although there was some difference with the UK and Australia underperforming due to higher than expected inflation and a greater resolve by central banks to combat inflation. The majority of central banks kept raising interest rates over the quarter. However, as I mentioned, the Fed was the first to pause in June. Obviously, all of this is relatively short term in the investment world. 3 months is a very short time frame. So if we move on and look at the longer term, so here we can see the same global markets, but over the last 1 year, 3 year, and 5 years. Whilst returns are positive over 3 and 5 years across all of the assets, there is some variance. There we can see that they jostle between best performing. It's a key reason for why we have exposure to various asset classes and regions in our portfolios to provide that high degree of diversification. If we look at global factors, again, if we look at 3 and 5 years, all of them have delivered a positive return. Again, varying degrees at various timeframes, but again, just underpinning the importance that they actually pay to the portfolios. What we don't find in portfolios is that every asset class and every sector performs the same at the same time. What we want is when one's performing badly, that there's another one that's actually compensating for that. If we move finally on to defensive assets, as we would expect, we don't see large gains in these asset classes as their role is to provide a cushion during market volatility as opposed to capital growth. But what is important here is I've included the global approach that we take in comparison to the UK equivalents, and really emphasising the benefit of taking that global approach and not being too focused on one country. Because as we can see, the UK has felt larger declines in the bond holdings than the global counterparts. So the diversification benefit there is really prominent. Now, finally moving on, as many of you know, we don't believe in crystal balls. We don't know what's going to happen tomorrow, next week, next month, next year. But we're not going out on too much of a limb by saying, okay, well, what if some of the conditions we're seeing today get worse, and what threat does that have to the portfolios? And how are our portfolios structured to help you? So if we look at the first one here, so UK's inflation rate is expected to fall steeply towards the end of the year. But obviously there's risks to that as it being a forecast. As I said, we don't actually know. Therefore, this could impact on yields and bond prices if inflation remains high and the Bank of England continues to raise interest rates. Our key mitigation here is that it's continuing with a sensible portfolio structure. Whilst inflation is growing, what we do see is that long-term evidence shows that by holding growth assets, that provides a long-term protection to inflation. Again, the key bit there being long-term. The next one kind of links again, touching on rising interest rates. Another key risk being if they continue to rise, where do we go? Higher than expected or prolonged inflation could mean that central banks continue to continue to increase rates. And the impact of that is being that that would result in falling in bond prices, as we saw last year. The key mitigation here is that Portfolio Sense continues to adopt a sensible fixed income positioning and holding short duration exposure. This means that should interest rates rise, it has a limited impact on the price. We see the opposite when it's a longer duration. It means that there's a bigger fall in price. So our short duration position helps capture less of the fall, so to speak. Moving on to the next one, we continue to see the terrible conflict unfold in the Ukraine. This is coupled with deteriorating relationship between the West and China. Unfortunately, there is still room for this political tensions to increase. Here, the mitigation is to not overreact and remain disciplined. We have a well-diversified strategy. We mitigate, therefore, some of the shorter-term market uncertainty, and the high-quality short-duration bonds should support portfolio valuations during volatile periods. Finally, if we look at with rising bond yields, global recession fears, escalation of the war in Ukraine, this could all undermine markets, and there's room for downward movement. Markets have been relatively resilient despite everything that's been going on so far, but they still could go down. To protect our portfolios against this, maintaining this highly diversified portfolio, not over-reliant on one economy, one region, one style is a key defence. Whilst again, the high-quality, shorter duration bonds should help protect against should market falls occur. Hopefully you found this useful. We will continue to see markets react to events across the world. But from an investment perspective, it's really just remembering to be resilient, not overreact to anything that you hear in the news. The evidence supports that returns will be generated over the long term. We just don't know when they're going to come. And obviously, then they'd never come in a straight line. But what we do know is the best place to be when they do come is to be invested. As I said, hopefully you found that a useful summary. Should you have any further questions or want any more information, then please don't hesitate to contact your financial planner. We'll be more than happy to help you. Thank you very much.